that when others are fearful, you're going to get scared yourself. You know, you are not going to make a lot of money in securities over time in all probability.
Every bull market, someone thinks this time is different. Millions are making the same bet. AI stocks keep rising. This feels like the beginning. Nvidia up 115% in 12 months, the symbol of the AI boom. Capital flooding into AI infrastructure. Data centers, GPUs, cloud, all expanding fast. Same story everywhere. Markets racing to price in the AI future. But something quietly shifted. 7 companies. Nearly 30% of the S&P 500. If those 7 stop rising, cracks appear fast. 3 signals, flashing now. Market looks healthy on the surface. S&P near all-time highs. Investors call it a structural bull market. Past year, S&P 500 up 17.9%. By any standard, a strong return. One adjustment, equal weight every company. Picture changes completely. Equal weight S&P, only 12.1%, a 6-point gap from a handful of stocks.
That number has been slowly declining over time, and it just indicates a narrowing of the rally.
Remove a handful of mega-cap tech stocks from the index, and this rally suddenly looks far less impressive. History is surprisingly consistent here. Markets that become this concentrated often turn out to be more fragile than they appear. Think of it like a car running on only 1 or 2 wheels. Yes, the vehicle may still move forward, but the stability underneath it is already weakening. And once that balance finally breaks, the entire system can come apart faster than most people expect. The second signal comes from valuation. Because a stock price is never just about today. It reflects what investors believe the future will look like. Right now, Nvidia trades at roughly 47 times earnings. That valuation assumes explosive growth will continue. Even on forward estimates, the stock still trades around 32 times earnings, meaning strong future performance has already been priced in. The PEG ratio sits close to 1. The market is essentially saying future growth will justify today's price. But that only works if the growth actually appears. Corporate investment in AI infrastructure continues to surge. But markets don't actually need bad news to correct. Sometimes expectations simply drift too far ahead of reality. Think about housing. If a home is priced assuming 10 years of income growth, even a modest slowdown can push prices lower. Most bull markets don't end with disasters. They end when expectations quietly outrun reality. The third signal comes from market structure, specifically how money flows into the system. In 2025 alone, AI-focused ETFs attracted about $19 billion in inflows. At the same time, passive funds tracking the S&P 500 now control over $8.5 trillion. These funds don't analyze companies. They simply buy whatever stocks have the largest weight. So a feedback loop forms. Prices rise, weights increase, passive funds buy more. During bull markets, this amplifies gains. But during corrections, it amplifies declines just as quickly. Now imagine a different scenario. AI stocks don't crash. They simply stop rising. Momentum fades and prices move sideways. At first, most investors say the same thing. This is just a healthy pullback. Time to buy the dip. Then the second decline arrives. Confidence begins to crack.
Let me make this point.
Suddenly, a new question appears everywhere. Is the AI trade becoming crowded? Losing 20% means needing a 25% gain just to break even. If losses reach 40%, the recovery required jumps to 67%. Recoveries like that rarely happen quickly. They often take years. Successful investing isn't about calling the exact top. It's about avoiding the kind of loss you can't recover from. Because markets rarely collapse when everyone sees the risk. They collapse when the risk becomes invisible. Thank you for watching. I appreciate you taking the time to think through this with me.